Welcome to part 3 of the Chapter 1 lecture series. This particular learning objective that we're starting with here is the most important building block of accounting that we have, and it's really important that you get this down and you really understand what's happening. We're going to define and interpret the accounting equation in each of its components. Everything is built on this equation. The accounting system reflects two basic aspects of a company: what it owns and what it owes. Assets are resources that a company owns or controls. Examples are cash, supplies, equipment, and land, where each carries expected benefits. The claims on the company's asset, what it owes, are separated into owner and non-owner claims. Liabilities are what a company owes its non-owners, creditors, in future payments, products, and services. Equity, also called owner's equity or capital, refers to the claims of its owners. Together, liabilities and equity are the source of funds to acquire assets. So think of it this way. You own a car. Now, I always say I own my car even if I'm still making payments. The liabilities of that asset car are what I still owe on the car. The equity is the portion of the car that has been paid for. When you're thinking about liabilities and equities in terms of assets, that's what we're talking about. Assets are resources a company owns or controls. These resources are expected to yield future benefits. Examples are web servers for an online service company, musical instruments for a rock band, land for a vegetable grower. The term receivable is used to refer to an asset that promises a future inflow of resources. A company that provides a service or product on credit is said to have an accounts receivable from that customer. So you will see the term purchased on account. That means we have offered this particular customer credit and he gets to pay at a later date. Liabilities are creditors' claims on those assets. These claims reflect the company's obligation to provide assets, products, or services to others. The term payable refers to the liability that promises a future outflow of resources. Example, wages payable to workers, accounts payable to suppliers, notes payable to banks, and taxes payable to government. Receivable means someone owes me money, I'm waiting to receive it. A payable means I owe someone something and I am obligated to pay them. Lastly, we have our equity. It's the owner's claim on assets, and it is equal to assets minus liabilities. This is the reason equity is also called net assets or residual equity. Equity is increased by the owner's investment. It's called stock issuance and from revenues. It is decreased by dividends and expenses. Equity consists of 4 elements: contributed capital or common stock. This is when people invest money in our company and we give them stock in exchange. Revenues are money we make from doing the service or selling our product. Dividends are when we are paying back money from the earnings to our owners or our investors. Lastly, expenses are the money I spend to keep my doors open and do business. Net income occurs when revenues exceed expenses. Net income increases equity. A net loss is 0. Here's one of our need to knows. Let's go over this and see what we have retained. Use the accounting equation to compute the missing financial statement amounts. We know that the accounting equation states that total assets must equal the sum of total liabilities plus equity. For Bose Company, $150 of assets equals liabilities of $30 plus equity of $120. For Vogue Company, $100 of liability plus $300 of equity equals total assets of $400. We can see in the equation, to get this, I subtract the liabilities, I get my equity of $120. Liabilities plus equity, that means that my assets should be $400. Use the expanded accounting equation to compute the missing financial statement amounts. Now, I want you to look at the expanded accounting equation. And I didn't bring this up on the first slide. I'm sorry about that. Equity inside the equity, what I call the umbrella. I have my common stock. This is money that's invested into the company, or money I may put into my company in exchange for a piece of the company, the stock. Dividends are part of the net income that I pay to the owners. I don't have to, but I can. Revenues are the money that comes in for the services or product I sell, and expenses are the money I have to pay in order to do business. What do I have to pay to keep my doors open? I have to pay the mortgage, I have to pay insurance, I have to pay perhaps staff salaries and things of that nature. For Tesla, 200 of assets, 80 of liabilities equals 120 of equity. Of that 120 of equity, $100 is stock. I don't have any dividends, and the expenses are going to be taken away from that. So how much would my revenues be? $100 in common stock. I have no dividends. I've incurred expenses of $140. So that makes that $60. It's supposed to equal 120, so that tells me, because I've got the 100 minus the 40, gives me 60. I'm supposed to equal 120, so my revenues have to be 60. Now YouTube has a total equity of $240. Of that equity, 220 is common stock, 120 is revenues, and $90 are an outflow for expenses. So if I take the 220 plus the 120, that gives me 340. Subtract the 90, it's 250. Total equity is 240. Dividends are an outlay. I'm sending money out. Notice it's a minus sign, so this has to be 10 for the dividends with the brackets for negative. Again, as a review, with the 150 of assets, we have our liabilities of 30. We subtract that, we know our equity is 120. With Vogue, the 100 plus the 300 means that our assets should be 4. With Tesla, we have $120 of equity. Common stock is 100. Expenses are 40. That means I still need $60 to equal because the 40 is being subtracted. Lastly, with YouTube, 220 in common stock, 120 in revenue, and 90 in expenses. I need to come up with $240. If I add the 220 and the 120 and subtract the 90, I get 250 dividends. What we see here, it subtracts from common stock, as do expenses. So this is a negative 10. I'm going to go ahead and end this particular video here because the next video is going to be really long and I don't want to have them together. So I will see you later in part 4.